Hi guys, hope you're well. Welcome back. This is a new episode of True Fair Value, and my name is Alexander. And today we're going to determine the true fair value of PepsiCo. You all know this company. It produces drinks, beverages, and snacks, and it's going to be really easy to determine the true fair value of PepsiCo. Let's go. First of all, we start from the top line. You remember from the previous episodes that this is really easy to do. We just look at their latest financials, and they were published on October 5th, a few days ago. So let's start by looking at the revenue. They showed a revenue of plus 12%. That's really good. A double-digit growth of a company like PepsiCo. It's a huge company that's been here for a while, and double-digit growth is quite good for a company like that. Let's look at the impact of foreign exchange. Remember, this is a company that sells not only in US, not only in North America, but all over the world. So the FX, the foreign exchange impact can be quite large. But this year was only 2%, which is not crucial, plus 2%. So without the FX impact, it would be 10% growth. Not bad, also double-digit growth. Let's look at the margins. What's going on with the expenses? We see that the gross profit is plus 9%. Well, that's less than the plus 12%. So what's going on? Their cost of sales went up by 15%. That means they're spending more money to produce the stuff they're selling, to produce the beverages, the drinks, and the food and the snacks that they're selling. Well, this is not a surprise. We all heard about wage inflation, supply chain constraints, shipment costs going up. So this is something that we could expect to see. Let's look at the selling, general, and administrative expenses. Then they went up 10%. Well, more or less the same as the revenue without the FX adjustment. So the operating profit is going to be lower. It's going to be plus 5%. But that's not bad. Anything above 5% actually is good. Is a long-term rate that we're factoring in is approximately 7-8% for a company that size in the consumer business. But we'll see what the CEO is saying, what he is projecting, so we can compare our view and the view of the management a little bit later. Let's look at the bottom line first. The bottom line is negative. Why is that? We have seen just positive numbers. The revenue is up, the gross profit is up, the operating income is up. Why is the bottom line? Why is the net income down? It is the tax rate. This year it was higher than last year. This has to do with accounting, so let's not really look deep into the tax rate because it will even out and it's going to be a little bit over 20% on the long term. So year, like quarter to quarter, this does not make a significant difference, especially when we're trying to establish the true fair value looking at a 10-year horizon from now. So let's just count the tax rate at a little bit over 20% for the time being. We'll wait for what the U.S. administration will say about the tax rate going up or not going up that high. We'll know a little bit later, but now we're factoring in a long-term rate of a little bit over 20%. So let's look at the EPS, the earnings per share. They're also down because the company, they did a little bit of buybacks, so they retired some, I think it was 10,000 shares, so it's not a big number. So mostly the net income is the same as the earnings per share, is what we make as a shareholder for every share that we hold. Now let's look at the cash flows and cash distribution. A company of that size and in this business should be making a lot of cash because they're selling on a daily basis the products, the drinks, the beverages, the foods, the snacks. They should be getting cash. Let's see how much they made from their operating activities this quarter. They made 6.6 billion, which is up 8% per year. See again, 8%. This is something that we factor in. A little bit over 8% is a normal rate of growth for a company like PepsiCo. The company will return this year a total of $5.9 billion. Remember, they made 6.6 and they'll give back 5.9. 5.8 will be distributed via dividends, and 0.1 will be distributed via buybacks. And that already happened. The 10,000 shares that they bought back approximately totaled a little over $100 million, but that's not a big number. The main return of the cash goes via dividends in PepsiCo, and we like it actually. Remember, we always categorize companies depending on the reliability of the cash flows and the return of the cash to the shareholders. The company that pay out dividends, we like them more because the dividends are sticky. Companies usually do not lower the dividends once they start paying them out. And if we look at PepsiCo, for the last number of years, they have been increasing dividends on a yearly basis. Every year they are paying more than they paid the previous year. This makes us like this company that much that we put it in the first tier. We assign it to the elite, to the best of the best. It's a first tier company. Why do we do that? Remember, when we determine the value, the true fair value, we apply a risk premium, an equity risk premium to a risk-free rate, because we can always make money by not taking any risk at all. We can just buy a 10-year government treasury security, like a government bond, 10 years, and we'll be getting 1.5% with zero risk at all. So if we decide to take a risk, if we decide to go in the back of the line, to be the last ones to receive the payments as a shareholder of Pepsi. Remember, the first ones are the bondholders, and we see all the taxes, and then only the shareholders receive their part. So we're taking a lot of risk. The company, something might go wrong. The company may be not able to pay us the dividend, give us the money. So we have to be compensated for this risk. And given that this is a first-tier company, we apply a small premium of 4.5 percentage points, 450 basis points on top of the risk-free rate, which is 1.5. So that gives us approximately 6% yield. 6% return is what we should make to justify, to break even, to justify an investment into this company. Let's see first what the management is saying. Raymond, the CEO, he's a nice guy. Like this company has a good track record. The management was very consistent, and every time they promised something, they kept their word. This is one of the reasons why we make them a first-year company. They don't bullshit. Whatever they say, they put your money where your mouth is. They do what they say. So he's saying that the company will grow at a rate of 8% per annum. We totally agree with that. We assign from 7 to 9, depending on the overall macro environment. But again, this is a company that has logistics everywhere in the world. Wherever you go, like more or less countries that are safe to visit, you can always buy a Pepsi, because you always have a warehouse, you have a distribution center, sometimes you have a production nearby. And in any bar, in any store, any supermarket, any convenience store, anywhere, any gas station, all over the world. And believe me, I've been traveling all over the world. I studied in China, in India, in Chennai. I spent a number of years in Europe, in Russia, in London, in the Middle East. Pepsi is everywhere. These guys will not disappear because they're really in every part of the world. They have their facilities. So again, I'm explaining why this company is a first-year company, because the cash flows are quite reliable. The business model is stable. It's easy to predict how much money we'll generate and how much money we will get as shareholders, because there are no surprises. These guys are paying their money out to the shareholders every year, increasing their dividend payments. So all we have to do now is just input the numbers in the financial model. That's the easiest part. The hardest part is to come up with the numbers. But here there was no hard part, because Pepsi is a company that is really easy. It's very simple to value this company. So given what we said, the earnings per share that we are expecting to get, the 8% growth that the CEO is promising us, actually we're going a little bit down. Well, let's make it 7% growth just to be on the safe side. And if we input these numbers, what do we get? Try it yourself. What did you get? We got 4.19%. Remember how much we need to make to justify this investment? 4.5 percentage points over the risk-free rate. So that gives us at least 6%. And we get only 4.19 if we buy the stock now, if we buy the stock today, if we invest money at the current price. What does that say? That tells us that it's a sell. It's a sell on Rally's recommendation. We should not buy a stock. It will not break even. We will lose money compared to the benchmark. We're not making 6%. We're making less if we're buying it. So our recommendation is to sell on rallies. If the price will go down far enough to make at least 6% return, then we'll change the recommendation. So let's watch the stock price. Let's watch the sales. Let's watch the risk-free rate. And if something changes, we'll let you know. We'll update, not update the model, we'll update the inputs. We'll update the numbers that we put inside the model to get a new true fair value. Remember, never buy a stock before you determine the true fair value. This is the most important, the crucial part. You should understand what you're making if you're buying a financial instrument and losing access to your account. You have to count the money that you make if you are unable to input your password and to log into your account. This is like the worst case scenario. This is why we're using numbers a little bit lower than the ones that the management is promising us, because we are like being safe. And still, if you look at the previous episodes, we saw stocks that give us a double-digit yield if we buy them, even if we use conservative growth numbers, even if we use zero growth as we did last time. Still, we made quite a big return. But here it's only 4.19. So this is why our recommendation is sell on rallies. If you want us to value any stock in your portfolio, or you're thinking about buying a stock and you want to find out the true fair value and you cannot do it yourself because you don't know how to do it yet, just listen to our instructions or just drop me a message. My team will be happy to assist you. We'll show you all the calculations and give you the true fair value of any security, not even a US-based stock. It could be any stock all over the world. Remember, we have offices in Switzerland, in London, in Paris, in Moscow. We trade all over the world. So we trade all the securities there are in this world. Anything you're interested in, just let us know. Drop us a message and we'll help you out. All right, guys. Thank you for watching. I hope you enjoyed it. I hope you found it useful. So good luck trading. See you next time. Bye.